Have you noticed how easy it's become to get your favorite food delivered right when you want it? Today, it's not science fiction. It's everyday India. Now, as millions of urban customers tap their phones for food, grocery, essentials, or a quick pickup, two listed companies are racing to dominate how we live, eat, and shop. Welcome to Bottom Line by Grow. In this video, we're putting Eternal and Swiggy head to head. Their business models, their Q2 FY26 numbers, and what those results mean to you as an investor. Now, to understand how Eternal and Swiggy are performing, we first need to look at the world that they operate in, India's food delivery and quick commerce industries. And both of them have been on a remarkable growth path. Now, over the past few years, ordering food online has quietly become a part of India's urban lifestyles. From midnight biryanis to early morning coffees, the industry now delivers far more than food. It delivers convenience. According to a recent report, India's online food delivery market was valued at around $45 billion in 2024 and is projected to grow at nearly 23% CAGR between 2025 and 2033. Let's understand what's driving that massive surge. First, it's the rise of disposable incomes. Now, India's per capita income has more than doubled, but in GDP per capita terms, India stands near $2,200. It's far below China's $12,600 and the United States' $70,000. This wide gap shows how much headroom India still has for income growth. Secondly, it's the digital infrastructure boom. Your cheap mobile data, UPI payments, and smartphone penetration, all of that has created the perfect ecosystem. You have over 990 million smartphone users, and you have widespread digital payments. And that means food delivery is just a few taps away. In fact, more than 90% of food orders come through mobile apps, with digital transactions account for a vast majority of these payments. Third, the changing demographics. India's median age is just 28 years, and this younger population values time, variety, and instant gratification. Now, more dual income households, nuclear families, and working professionals are leading to consistent increase in food delivery frequency, even in Tier 2 and Tier 3 cities. Now, if food delivery was the first act, QC, quick commerce is the sequel, and it's growing even faster. Quick commerce focuses on delivering groceries and daily essentials within minutes. And according to a report, India's quick commerce market is already worth around 64,000 crore rupees in FY25, and it's projected to reach 2 lakh crores by FY28. That's a growth rate of nearly 45% CAGR, making it one of the fastest expanding consumer sectors in India today. Now, the quick commerce model thrives on India's dense urban clusters, a younger customer base, and improved logistics. But with rapid expansion comes rising costs, particularly in warehousing, delivery, and customer acquisition. In short, India's food delivery and quick commerce markets are booming. It's supported by a strong economy, higher incomes, and digital adoption. But competition is fierce and profitability is elusive. And that brings us to the key question. In this rapidly growing industry, which company, Eternal or Swiggy, is best positioned to win the long game? Now, before diving into the latest quarter, let's quickly look at where these giants stood in last year. In FY25, Eternal, which most of us still know as Zomato really, finally turned profitable, reporting a net profit of around 527 crore rupees on revenues of nearly 20,200 crores. Swiggy, meanwhile, clocked around 15,200 crore rupees in revenue, but ended the year with losses of around 3,000 crore rupees. For FY25, Eternal's cash flow from operations was 308 crores, but Swiggy had negative cash from operations of 2,169 crore rupees. Now, Eternal has been reporting net profits for the last 10 quarters, but a closer look that reveals that much of this profit came from other income and primarily treasury gains from bank deposits. Now, if we exclude this non-operating income, the company would actually be in a net loss position, with Q1 FY25 being the only quarter where it remained profitable even without this support. Now, this is a trend that investors should keep a close eye on going forward. So, as we entered FY26, Eternal was already in the green, while Swiggy was chasing breakeven. Now, coming to the September quarter of FY26, both companies delivered strong growth, but in very different ways. Let's look at the core business, food delivery. In Q2 FY26, Eternal's food delivery revenue stood at around 2,863 crores, and that was up nearly 22% year on year, while Swiggy's food delivery arm delivered around 2,206 crore, rising roughly around 22% year on year. But profitability tells a different story. Eternal's food delivery EBITDA came at around 503 crores, with a margin of about 5.3% of net order value. Swiggy's food delivery business, on the other hand, generated an EBITDA of about 240 crores, translating to a 2.8% margin, which is almost half of Eternal's margins, really. So, in the food delivery segment, Eternal leads on absolute profit and scale with better efficiency as compared to Swiggy, which is still catching up at this point of time. Now let's talk about a segment everyone's watching, QC, quick commerce. Now, both Blinkit and Instamart have been on an aggressive expansion spree. They're rapidly widening their network of dark stores across the country. And over the last few quarters, the two platforms together added over 900 new dark stores, with the most aggressive rollout taking place in Q4 FY25. Blinkit added 294 stores, while Instamart added 316, and that marks their biggest expansion phase yet. Now, as of now, Blinkit operates around 1,816 dark stores spread across Tier 2 and Tier 3 city, and it aims to scale that up to 3,000 stores by FY27. Instamart, on the other hand, runs around 1,100 dark stores across 128 cities, and while it continues to grow, its focus is shifting towards densifying existing markets and improving store efficiency rather than just expanding for scale. Blinkit, Eternal's quick commerce arm, reported revenues of 9,891 crores, showing a massive 756% year-on-year growth. But this jump isn't entirely from actual business growth. It's mainly because of a change in accounting policy. Now, Blinkit has shifted to an inventory ownership model, where it now books the full value of the product sold as revenue instead of just recording commissions and ad income like before. They reported an EBITDA of negative 156 crore rupees, which equals to an EBITDA margin of minus 1.3%. Swiggy's Instamart brought in about 980 crores in revenue, up 107% year on year, and its EBITDA loss of 849 crores, translating to a negative 12% margin as of GOV. So, Blinkit has taken the lead in scale and profitability improvement, while Instamart that continues to grow faster but is still a step behind on the margins. Now, if we look at EBIT as a percentage of revenue for their quick commerce business, Blinkit has improved sharply from about a negative 11% in FY24 to nearly a breakeven in FY25. In comparison, Instamart is still operating in negative margin territory. Blinkit is nearer to breakeven today, but Instamart is sprinting right behind. And this segment will decide who wins India's delivery wars in the long run. Now, one thing investors need to watch closely is the rising competition in India's QC space, the quick commerce space. What was once a three-player race, Blinkit, Swiggy, Instamart, and Zepto, is now drawing several new entrants. There are now over 19 active players. Yeah, 19 active players in India's quick commerce segment. Now, this includes major names like Reliance Retail, which is planning to expand JioMart Express, along with Flipkart Minutes, Spencer's Smart Rush, Big Baskets Now, all trying to capture the delivery in minutes market. Zepto, India's very rapidly growing quick commerce startup, now operates over 900 dark stores across 70 cities, and it is set to add approximately 150 new stores in the next quarter, reflecting its aim to scale fast beyond metros into Tier 2 markets. JioMart, part of Reliance Retail, is preparing for a serious push, leveraging its network of over 18,000 retail stores to fulfill ultra-fast deliveries rather than, building thousands of dark stores from scratch. At the same time, Flipkart Minutes is gearing up with the power of its parent Flipkart, and it plans to expand its dark store footprint to 800 by the end of 2025, positioning itself to challenge incumbents on both scale and speed. BB Now, that's the quick commerce arm of Big Basket, and they are rapidly scaling up with around 700 stores across 35 cities, and they plan to expand this to 900 stores across the country by the end of 2025, and they are leveraging Tata's retail network. And let's not forget Amazon now, the quick commerce arm of Amazon India, which has already rolled out 10-minute deliveries in Bengaluru with immediate plans for Delhi NCR and Mumbai, signaling their intent to dominate metro markets early on. With such deep-pocketed players entering, the battle for customers, delivery speed and market share will only get tougher. And that means profitability could remain under pressure even as the industry grows. But as history tells us how these stories play out, well, a few years ago, India's food delivery industry saw more than 10 active startups. You had Food Panda, Tiny Owl, Tasty Khana, Uber Eats among them, yet only 2 names survived: Zomato and Swiggy. Quick commerce could follow the same path, as many players start the race, but only a few will have the scale, efficiency, and stamina to finish it. It's still too early to call a winner in the quick commerce space. With so many players entering, and the sector could soon face consolidation, just like telecom did after Jio's entry in 2016, when low prices forced most operators to exit, leaving only a few strong players like Airtel and Jio in the game. Now, let's look at what lies ahead for both these companies, the opportunities driving the growth, and the risks that could shape their journey forward. Eternal's management expects its food delivery growth to recover gradually after bottoming out in early FY26. Now, the company is guiding for a 15% year-on-year growth in FY26 with a long-term target of over 20% once aggregate demand improves. The real growth driver, however, remains Blinkit, whose net order value surged 137% year-on-year this quarter. Now, the management expects Blinkit's strong momentum to continue, staying above 100% growth for at least the next 1 to 2 years, and that's backed by rapid network expansion. However, the management has also cautioned that margins will improve slowly because Blinkit is reinvesting gains into marketing and customer acquisition to consolidate its lead. In Q2 FY26, its quick commerce business grew 108% year-on-year, with management confident of achieving contribution margin breakeven by Q1 FY27. Now, the company believes higher advertising revenue and better utilization of large, mega-powered dark stores will drive profitability. The food delivery business remains the cash generator, with steady GOV growth of 18% year-on-year and a strong EBITDA margins of 2.8%, up from 1.6% a year ago. Advertising now contributes over 4% of GOV, and Swiggy expects this to climb to 6 to 7% over time as brands spend more on in-app visibility. However, Swiggy's plan to raise 10,000 crores through a QIP, despite holding over 4,600 crores in cash and expecting another 2,400 crores from the Rapido stake sale, has raised questions. On one hand, the company has guided that it expects to achieve break-even by the first quarter of FY27, yet on the other, it's preparing for a large fundraise. This fundraise might be to keep extra cash for future growth, but it does seem a bit contradictory to talk about turning profitable soon while also raising new money, and investors should keep an eye on this. Now, both Eternal and Swiggy are no longer just food delivery platforms. They're shaping how India eats and shops. Both Eternal and Swiggy are continuing to chase growth in their core and new businesses. Now, Eternal is ahead on profitability and scale, with Blinkit growing quickly and food delivery margins remaining stable, though higher marketing spends and regulatory risks could weigh in on near-term results. Swiggy, on the other hand, is planning to raise fresh funds, despite a strong cash position, suggesting that it is also prioritizing growth over immediate profitability. The real question: who reaches sustainable profitability first? Thanks for watching Bottom Line by Grow, simplifying business and investing for you. See you in the next episode.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.